In this lesson, we'll learn about the stock investing strategy and how we should go about determining which stocks to invest in. To do that, let's take stocks out of the picture for a minute and level set on why we invest in companies. When we invest in companies, we're taking cash out of our pocket in the hope that the business will grow, be profitable, and give us back more cash than we had put in. We want our hard-earned money to work for us and grow itself. That's the basic mantra. But it's important to point out something very important here because plenty of people lose sight of this, that it's the cash we care about. When we invest in a company, there's going to be a lot of noise out there like how much equipment or inventory it has, how much debt it owes, etc. But we shouldn't let these noise derail us. At the end of the day, we, as investors, care about how much cash the business can give back to us. All these other metrics, like equipment, inventory, and debt, only matter in the context of helping us determine the amount of cash the company can generate for us. Cash we can put into our bank account. We can use it to buy food or car or pay for college. The company will own a bunch of assets like machines, furniture, etc. But unless the company can convert them into real cash, it's really not that useful to us as investors. With that, it's evident to us that the value we're getting from our ownership of a public company is the value of all the cash that can be taken out from it and be returned to investors during its remaining life. This is known as intrinsic value. This is a key concept here that everyone should really keep in mind as we go through this course. So now let's bring stocks back into the equation and understand what we're paying and what we're getting when we purchase a stock. When we purchase a stock, we're paying in cash the stock price quoted on the stock market. In return, we get a proportional ownership that each stock represents in the underlying company. And this piece of ownership represents the proportional claim on all the cash that can be taken out of the business during its remaining life. This includes the company's existing cash, which is the cash it has already generated and just sitting in the bank accounts, as well as all the future cash that the company will generate going forwards. The cash here we're talking about are the free cash left over after paying for all the operating expenses to run the business and repaying the debt investors. The amount of cash that a company is free to give back to shareholders and still keep the business running. Price is what we pay and value is what we get. So let's think about that for a minute. If the value of all these cash that we're getting is higher than the stock price we're paying, then that's a pretty good investment. In other words, we're paying a price below the intrinsic value and we're profiting from the difference. Let's illustrate with an example. Suppose there's a company that has $1,000 in its bank account. For simplicity, let's assume it stopped doing business so it doesn't have any future cash coming in, and the $1,000 in the bank account is pretty much all that it has. It has 100 shares and the owner is willing to sell us each share in the company for $5. In this example, should we buy the stock? The answer should be yes. Of course we should buy the stock. There's $1,000 of cash we're getting, which is $1,000 of intrinsic value. There's 100 shares, so each share has a value of $10 per share. The owner, who probably didn't take this course, is offering to sell us each share for $5. So we're paying $5 for a stock that entitles us to $10 of cash in return. We're effectively buying a $10 bill for just $5. That sounds like a pretty good investment and we should buy the stock. On the other hand, if the owner is trying to sell us each stock for $20 per share, should we still buy the stock? No, we shouldn't, because that's like saying we want to pay $20 for a $10 bill. But anything lower than $10 per share, which is the intrinsic value, would make sense for us. This is the general idea of what we're doing when we analyze a stock. We're trying to figure out how the intrinsic value compares to the stock price. But profiting from the gap between price and value is just half the story. That's because intrinsic value doesn't stay constant. It's not like a company has one particular intrinsic value that stays constant throughout its lifetime. It doesn't. Intrinsic value changes over time. Fundamentally strong businesses are much more likely to benefit from future increases in value, whereas poor, low-quality businesses are bound to see their value chipped away. That's why we don't just look for stocks priced below intrinsic value, but specifically stocks of high-quality businesses priced below intrinsic value. The risk with investing in a fundamentally low-quality business, even if we purchase it below intrinsic value, is that whatever excess value that exists at the time of our investment could be wiped out during our holding period as the intrinsic value declines over time. But by investing in high-quality businesses at prices below intrinsic value, we profit on two fronts. We profit from the gap between intrinsic value and price, and we get the additional kicker from future increases in value. This is the essence of fundamental analysis. This is the same approach that Warren Buffett preaches and a recurring theme of our courses. So now we've established logically that the stock investing strategy is to invest in stocks of high-quality businesses at prices below intrinsic value. But we make money in the stock market by buying low and selling high. The stock price has to go up in order for us to make money. Logically, some of us will ask, what does intrinsic value have to do with the future share price? This is really a key question, and we're going to show how the stock prices move in relation to intrinsic value in the next lesson. Hey guys, thanks for watching. Hope you found this video helpful. We've been working hard on our Lumovest website, where we will have hundreds more videos like this and exercise sheets and quizzes to help you learn stock investing. We're actually planning to launch Lumovest really soon. To be the first to know when we launch, visit our website right now where you can sign up to be notified when we go live. Simply input your address in here and we'll shoot you a note when we launch. You can also share your unique link with friends and earn rewards. This is for a limited time only though, so do it fast. Anyways, really glad that you're here on our channel. Hope you find it helpful and hope you decide to subscribe. If you have any questions, feel free to drop us a note in the comment section and we'll try to get back to you. As always, we'll be looking forward to seeing you in our next video.